Hello friends, in this lesson we shall have discussion about contribution sales ratio. Friends, contribution sales ratio is an important financial tool which is made use by firms, analysts, etc. What is this ratio? Friends, contribution ratio or CS ratio, it measures the efficiency at which a business firm can produce goods and services at low variable cost. So this ratio reflects the efficiency. Efficiency with reference to what? With reference to production of goods and services at low variable cost. Friends, cost has two components. One component is called variable cost, other component is called fixed cost. Every business organization which is producing goods and services, they are incurring these costs. What is variable cost? Variable cost is also known as direct cost, and it is the cost which is directly related to the volume of sales. So this cost changes with volume of sales. And fixed cost is that cost which does not change with the volume of sales. It remains constant. And sum total of these two, it is total cost component. As regards contribution, how do we calculate the contribution? Contribution is calculated as sales minus variable cost. So it could be total sales minus total variable cost, or it could be unit sale price minus unit variable cost. This contribution, first it is used to cover fixed cost, this one, and if still some amount remains, then that becomes profit of the organization. This means contribution is appropriated towards two things, fixed cost and profit or margin of safety. First, it is appropriated towards fixed cost and remaining part becomes profit. How this ratio is calculated? CS ratio is calculated as contribution divided by sales. So it is calculated as a percent or in decimal. If this ratio is higher, the higher CS ratio indicates that contribution from sale is more. And in that case, the fixed cost will be covered very early and the firm will be able to reach the break-even point very early. In other words, we can also say, if a firm is having a higher CS ratio, it will be more profitable firm. On the other hand, a firm with a lower CS ratio, it indicates that contribution is less. And if contribution is less, then fixed cost will be covered little later. And that will delay the reaching to break-even level. In other words, we can say, in case the CS ratio is lower, it will take longer time to break even, and that also means the lesser profits. Friends, CS ratio can be calculated for single product also, for multi-products. If a firm is producing one product, it can be calculated for one product. If it is manufacturing more than one product, so it can be calculated for multi-products also. What is advantage of calculation of CS ratio? Why this ratio is popular with financial analysts and with the firms? First, management can calculate a break-even point for each department or product. Every management of goods and services firms, they are interested how early they can reach the break-even. So this break-even calculation can be calculated for departments individually also, and it can be calculated for different products also. Secondly, management can understand as to which product is more profitable and which product is less profitable and which product is required to be discontinued. Let us now see a case study to understand practical application of this ratio. We are given this information. XYZ Limited are producing two products. These are named A and B. The information relating to these products for previous financial year is as under. So here we have product A and product B. Selling price per unit rupees 100 in respect of product A, rupees 80 for product B. Number of units sold in the previous financial year 16,000 for product A and 10,000 for product B. Variable expenses for product A 70, for product B 42. Total fixed expenses involving all these products rupees 5 lakh. And other information which we have to provide now. Calculate product wise CS ratio and combined CS ratio. Now we shall proceed in calculation. The sales amount, that is selling price into number of units, it is 16 lakh in case of A and it is 8 lakh in respect of product B. Then variable cost. Per unit variable cost is 70 rupees. For 16,000 units, it will be 11 lakh 20,000 rupees. In respect of B, at 42 rupees per for 10,000, it will be 4 lakh 20,000. And contribution will be according to formula 480 in respect of product A, 16 lakh minus 11.20 lakh, 4.80 lakh for product A and 3.80 lakh for product B. Now we can calculate the CS ratio. So CS ratio is 30% in respect of A, 4.80 divided by 16 lakh, we get 30%. Similarly, 3.80 divided by 8 lakh, we get 47.5. So here we can see that the contribution coming from product A is lesser as compared to coming from product B. It means by offering product B to the customer more than product A, this company can increase its profit. And the combined CS ratio, it can be calculated as the sum total of total contribution, that is 480 plus 380, this is 860, and sum total of total sale, that is 16 plus 8, so 24 lakh and 35.8, that is combined CS ratio of this firm. Out of this, 30% is coming from A and 47.5 it is contribution of product B. Friends, after this simple exercise, let us now go to a little more complex exercise. Based on this information, we are to calculate number one, what is break-even sale point or what is break-even point sale of this firm. Second, the safety margin for existing sales. And third question is sales for product profit of rupees 10 lakh. So if a profit target is 10 lakh, how much sale should take place? So these are the decisions which we have to take on behalf of this firm. Here is an assumption also. The ratio of sales to variable cost in respect of product A as well as in respect of product B, that is assumed to be constant. That ratio remains the same. Now we go for the solution. Break-even sale. Break-even sale can be calculated as fixed cost divided by CS ratio. So fixed cost here is rupees 5 lakh and combined CS ratio is 35.8. Hence this is break-even sale, 19,37,984. Now safety margin. Safety margin can be calculated as total sales minus break-even sales. The total sales already we have 24 lakh and break-even sale is calculated by us, hence 4620515. So it is amount of safety margin. Safety margin is also profit amount. So profit earned by this firm on this existing operation is 462,015. Our next question is, if a profit target is 10 lakh rupees, then how much will be the sale for that purpose? we can make the calculation. So sales to achieve target profit, it can be calculated with the help of this formula. Fixed cost plus target profit entire divided by CS ratio. Fixed cost we have 5 lakh, the target profit is 10 lakh and the CS ratio is 35.8, and this is the amount of sales to have a profit of rupees 10 lakh on the existing cost factor. That is how these ratios can be calculated, and by using these ratios the management of firms, they can take a decision which product to be preferred, which product is to be discontinued, and similarly the financial analyst, they can also evaluate the firms from profitability and other aspects. Well friends, I'm sure the contents of this video will be beneficial to you. In case you liked the video, please do not forget to subscribe to the channel, and thank you for watching the video.